All right. So that we're all on the same page, starting off with the weekly macro outlook. Remember that through my travels over the next couple of days, I'll make sure to update you all in the Discord with these updated reports. I will also try my hardest. I don't know what my schedule is going to look like on the day that I'm traveling, but I'll try throughout the week to give you guys the pre-market breakdowns, the morning briefings to keep you all aligned with what I see as the daily or intraday price action for NASDAQ. But so that way we're all on the same page. Let's cover this thoroughly because there is a lot going on in the global macro outlook that we all need to be very attentive towards this week as we roll into the first full week of August. So after one of the most volatile weeks we have seen in months, the total crypto market cap managed to stabilize over the weekend with only a modest recovery of a few $1 billion returning to the market. When we're done this, I do want to do a brief update on Solana. I think I'm going to start covering Solana's price action with the dark pools and start releasing these publicly. Obviously, of course, we'll do a brief update on our XRP tracking and take a brief look at Canton, albeit nothing has really changed out of those two pairs of the weekend from our last update. But just so that way we're all on the same page. And then once we're done that, we'll roll over into NASDAQ if then scenarios. Okay. While selling pressure eased following last week's liquidation, there has not yet been enough capital returning to suggest institutions are aggressively rotating back into crypto just yet. As you all can see, here is the most recent screenshot of the total crypto market cap with the weekly high last week coming in at $2.2 trillion, the weekly low coming in at 2.1 trillion, and from that weekly low, which was placed yesterday on Saturday, we have seen a small, slight, brief recovery back up into 2.15 trillion, with the market up currently about 11 to 12 billion dollars on the day. Instead, investors enter the new week facing another heavy macro calendar where geopolitical development, central bank expectations, treasury yields, Japanese currency volatility, labor market data, and another wave of earnings will likely dictate sentiment across both crypto and traditional markets. Unlike previous weeks where the Federal Reserve dominated headlines, attention is now becoming much broader. Markets are attempting to determine whether inflation risks continue building, whether central banks are forced to remain restrictive for a prolonged period of time, and whether AI-driven corporate earnings can continue to support equity valuations despite growing macro uncertainty. First, on our radar, the Middle East remains the largest wild card right now. The biggest uncertainty entering the new week continues to be the Middle East. Over the weekend, President Donald Trump unexpectedly announced he had canceled plans to strike against Iran, saying he would hold off provided a deal can be reached rapidly. According to Trump, several Middle East countries requested additional time for diplomacy, and he claimed that the broad parameters surrounding negotiations, including discussions surrounding the reopening of the Strait of Hormuz, had largely been agreed upon. Now, I'm seeing conflicting headlines on this macro front already, where Iran negotiators are saying that none of this is true, that Trump is talking out of his hoo-ha. So it'll be very interesting to see how the market opens up during the Monday rollover. However, we know that optimism still remains extremely fragile. Iran has not confirmed requesting negotiations, nor has it acknowledged any framework agreement. Instead, Iranian officials have continued warning that any additional American or Israeli military action would receive a decisive and proportionate response. Iran's acting defense minister reiterated over the weekend that every threat from its adversaries should be viewed as a real and credible, warning Tehran would neither remain passive nor be caught off guard. Meanwhile, reports continue suggesting that the United States and Israel have prepared contingency plans targeting Iranian energy infrastructure should diplomacy fail. And we know that that would obviously, of course, be one of the worst case catalysts heading into the new week. If we see reports this week that Trump is attacking civilian infrastructure, that could lead to a broader escalation. American officials have also urged U.S. citizens throughout the Middle East to remain prepared for rapid evacuation if tensions escalate. Adding another layer of uncertainty, Israeli Prime Minister Benjamin has remained largely silent following Trump's announcement and their meeting in D.C. last week. While Washington appears increasingly interested in pursuing diplomatic solutions, Israel continues viewing Iran's nuclear ambitions as its highest strategic priority. Israeli leadership has consistently favored stronger military pressure on Tehran and may be considerably less willing than Washington to accept compromises. The Gaza conflict also remains unresolved. Although Hamas has reportedly shown willingness to discuss phased disarmament, implementation still remains conditional upon Israeli troops withdrawing. while Israel leadership continues resisting restrictions on future military operations inside Gaza. So, in short, diplomatic headlines have improved sentiment modestly, but the probability of renewed escalation still remains elevated. So, that is why we will be paying attention to those things in these headlines this week. Why, of course, this matters for markets. We know that markets are no longer simply reacting to missiles, they are reacting to inflation and oil outlook and things of that nature, right? What drives monetary policy. Every military escalation increases the probability of a disruption to global energy supplies. Although oil prices have eased from last week's highs, shipping through the Strait of Hormuz remains vulnerable while attacks around the Red Sea continue creating logistical challenges for global trade. Should a military conflict intensify again, higher oil prices would likely feed directly into inflation expectations, making it significantly more difficult for central banks, including the Federal Reserve, to justify rate cuts or even maintain their current stance. For both crypto and equities, lower energy prices are bullish. Higher energy prices, of course, are not. We know that Treasury yields last week in particular, with Friday seeing a high that we haven't seen since, I believe, 2025, and Treasury yields are becoming just as important as the Federal Reserve. While investors often focus entirely on the Fed, Treasury markets may now be providing the more important signal. Last week, we had the 10-year Treasury yield surge toward 4.7%, while the 30-year yield climbed above 5.2%, levels not seen since the beginning of 2025. You can see that here. Higher long-term yields tighten financial conditions naturally by increasing borrowing costs throughout the economy, affecting mortgages, business loans, auto financing, and corporate investments. Even if the Federal Reserve chooses not to raise interest rates immediately, rising Treasury yields effectively perform part of the Fed's job by slowing economic activity. Markets, therefore, entering the week, are asking a critical question. Have Treasury yields already tightened financial conditions enough to reduce the need for additional Fed hikes? If yields stabilize or begin falling, risk assets would likely receive meaningful support. However, if yields continue pushing higher, which is worst case scenario for risk assets, financial conditions become increasingly restrictive, which would limit the upside for, of course, both equities and crypto and probably lead to some downside momentum. One of the biggest catalysts is the Japanese yen carry trade unwind. One of the largest risks to financial global markets sits in Japan. Last week, the Japanese yen recorded one of its strongest rallies in months following speculation surrounding additional government intervention and expectations the Bank of Japan could continue raising interest rates after already lifting policy rates towards 1%. While those numbers appear small compared to the United States, they carry enormous consequences globally. For years, investors have borrowed extremely cheap Japanese yen before converting those funds into higher yielding assets, including US stocks, bonds, and particularly crypto. This became known as the yen carry trade. When the yen strengthens rapidly or Japanese interest rates rise, leveraged investors begin unwinding those positions. That process forces widespread selling across global risk assets. History has shown previous Bank of Japan tightening cycles often coincide with meaningful Bitcoin and altcoin corrections. While in August 2024 demonstrated how quickly carry trade liquidations can ripple through every major financial market. If you guys remember being in this community, we have covered that extensively in past video breakdowns, and it still lingers as one of the biggest risk catalysts as we head into the remainder portions of 2026, 2027, and beyond. Institutional investors will therefore likely spend the week watching USD JPY almost as closely as they watch Bitcoin itself. Continued yen appreciation could significantly reduce global liquidity available for speculative assets. Beyond all that, we have labor market data. So, of course, beyond geopolitics, major central bank policy, we have U.S. labor market data. Friday non-farm payroll reports are expected to show approximately 91,000 new jobs created during July, improving from June's week report of 57,000. Unemployment is expected to edge slightly higher towards 4.3%, while wage growth is forecasted to remain steady around 0.3% month over month. We will also have multiple different scattered labor market reports throughout the week, like JOLTS job openings, ADP employment. We also have some ISM figures, factory orders, productivity, unit labor costs, and trade balance figures. Collectively, these reports will determine whether the U.S. economy remains resilient enough for the Fed to continue discussing additional rate hikes later this year. A strong labor market could reignite hawkish expectations from the Federal Reserve, whereas a weak labor market would support the argument that financial conditions have already tightened enough. Last but not least, we have earnings seasoning, especially for us as NASDAQ traders. Earnings season will remain one of the biggest drivers of market sentiment this week, particularly as investors continue evaluating whether hundreds of billions of dollars being invested into artificial intelligence are translating into real revenue growth and stronger corporate profitability. Last week's reports from Microsoft and Amazon significantly boosted confidence after both companies demonstrated accelerating cloud demand and showed that aggressive AI investment is beginning to generate measurable financial returns. This is a perfect example of why this stuff is so important to pay attention to, because literally midweek last week, out of the blue, after NASDAQ sold off aggressively, sellers started taking profit, and we went on a 48-hour bull run in NASDAQ, where NASDAQ jumped from dark pool to dark pool, and for 2 days straight, there were nothing but just straight aggressive buying opportunities, right? And it was primarily because investors were more optimistic about buying into the NASDAQ due to these upbeat earnings that we got. The results helped fuel a powerful recovery in tech stocks and the NASDAQ, but investors now need to see whether that strength can extend across the broader AI ecosystem. Monday's focus will turn towards Palantir Technologies. On Semiconductor, Palantir has become one of Wall Street's premier AI software companies, and investors will be watching government contract growth, commercial AI adoption, customer expansion, and management's forward guidance. On Tuesday, brings one of the week's most anticipated reports with Advanced Micro Devices, or AMD. On Wednesday, we'll shift our attention towards memory manufacturers like SanDisk and Western Digital. Outside of the tech stocks that are going to be providing their earnings reports, we will closely monitor Eli Lilly, Novi Nordisk, as both pharmaceutical giants continue competing for leadership in the rapidly expanding obesity and diabetes treatment markets. We also have Walt Disney, and we also have ConocoPhillips, along with SpaceX. All right, SpaceX isn't going to report, I believe, until Friday, but still, nonetheless, a huge earnings season continuation overall this week. Overall, to wrap this up, the earnings will determine whether last week's small recovery in tech stocks has enough fundamental support to continue. If companies continue demonstrating that AI investment is producing tangible revenue growth, improving margins, and stronger forward guidance, risk assets could build on recent gains. Inverse to that, of course, if guidance begins to weaken or companies struggle to justify elevated valuations after months of aggressive AI spending, volatility could quickly return across both equities and crypto markets, weighing on risk assets to the downside. Now, as more specifically for the crypto sector earnings that are set to come out, last week we got earnings from both Coinbase. Hold on, let me just read this. We got earnings from Coinbase and MicroStrategy. Both of them reported disappointing quarterly earnings, resulting in last week as weaker digital assets prices decline and trading activity continued to weaken. Those results have raised fresh concerns about broader crypto sector earnings. Attention this week will now shift towards Circle, which reports this week on August 5th, alongside Marathon Digital shortly afterward. Strong earnings, of course, from Circle could reinforce confidence that stablecoin adoption continues accelerating despite broader market weakness. Weak guidance on the opposite side of the spectrum will likely reinforce concerns surrounding slow institutional participation within digital assets. So, to cover these scenarios very plainly and straightforward, this is what we're going to be looking for this week for a Goldilocks bullish rainbow scenario for both crypto and equities, where although we might not see all of these things in tandem with each other, we could see a handful or all of these things. One of these things has the potential, depending on how hard the market gravitates towards it, to lift risk asset optimism. Those things would be continued diplomatic progress between the US and Iran, oil prices stabilizing or preferably moving lower, Treasury yields easing from recent highs, USD JPY stabilizing without any aggressive yen appreciation, labor market data soft enough to reduce September rate hike expectations and keep recessionary fears off the table, ISM service figures showing moderate economic expansion without overheating, AI earnings continuing to demonstrate strong monetization rather than simply higher spending, strong guidance from Circle and additional positive crypto sector earnings, and continued institutional buying following last week's massive liquidations to the downside. Flip that scenario on its head, of course, any military conflict escalating across the Middle East, any disruptions or further, bad negotiations happening, Strait of Hormuz closing, more oil prices resuming to push sharply higher, Treasury yields continuing to climb towards new cycle highs. The Japanese yen, worst case scenario, right here, I think personally is still lingering in the background is the yen carry trade unwind. So any Japan strength or the Japanese yen strength accelerating carry trade unwinds. U.S. labor market data surprising significantly stronger than expected, which revives the September rate hike expectations. And any earnings season's disappointments or releases disappointing, where companies fail to justify elevated valuations. Circle or any other major crypto companies delivering weak guidance, which right now we just have Circle on the forefront. Institutional capital continuing to rotate towards defensive assets, right? So these are going to be our if-then scenarios for next week that we're going to be mindful of. Every single day next week, though, during the next rollover into Asia session, I'll make sure to update you all for the intraday sentiment for that specific day on what comes out. So with that in mind, real fast, taking a look first at XRP. In a bullish scenario where we get that risk on environment, right now we're still seeing buyers defend the $0.03799 dark pool, where right now this base seems to be where buyers have thrown up a defense multiple times, absorbing sell volume. They've done it here in the past. They've now done it at the end of July and rolling over into the 1st of August into the weekend have also thrown up a passive defense. This could, however, still just be sellers taking profit before reaccumulating orders at highs before pushing lower. So if we want to see this turn into a sustainable rally, nothing has changed from our previous analysis. We need to break above that $1.29 threshold. We have a few hurdles to overcome before then, turning and holding the $0.03 into a support. Breaking above $1.09 would coexist with the break above the 50 moving average and start to make our way towards $1.16. $1.16 becomes the most immediate threshold where passive sellers, after becoming aggressive, have defended these two highs here. We need to break sustainably above that, turn $1.16 into support, maybe even consolidate around $1.16 for some days, hold it, and then we could see a possible meaningful recovery back up into $1.29, where we're likely going to see a huge battle between buyers and sellers at this level. Right now, that would be bullish scenario for XRP if we can hold above $1.03. At least, maybe even just see some choppiness in between $1.03 and $1.16. Just ranging in between these two dark pools would even be a bullish scenario for this week, as long as we do not break below $1.03. In an extreme bullish environment, if we do ever overcome that $1.29 threshold, I'm sure we'll have more Zoom calls and we can start to anticipate and look at higher price levels. But for now, $1.16 to $1.29 become the most immediate bullish thresholds that we need to see buyers overcome sellers at if we want to get optimistic of any higher XRP prices. Same thing to the downside, still coexist. I feel like I've been beating a dead horse. XRP has been kind of moving like molasses lately, but failure to break above $1.09, sentiment flipping risk off, and a break, sustainable hold beneath $1.03 instantly opens up the door for sellers to push down into that next dark pool at the 91-cent threshold. That's our most immediate downside target on XRP. We'll start to monitor and see how sellers and buyers transact volume at this level. If sellers do happen to overpower buyers at the 91-cent threshold, and we see another sustainable break and close below 91 cents, the next dark pool to the downside does not come in until 68 cents. On the higher time frame, one thing I am noticing on XRP is, to be completely fair with you guys, on the weekly, it would make sense if they closed the imbalances in these bullish candles from the rally back in November 2024 for them to come down, take all the liquidity underneath of these lows, and then push higher. And if you look on the charts, to be completely honest with you guys, I'm honestly leaning towards that scenario. As much as people are skeptical about it on the internet, it would not surprise me. Am I counting on it? No. Am I prepared for it if it happens? Yes. I have buy limits set between 68 and 91 cents with some small orders, and I have some larger orders sitting at the dark pool, at the delta at the 44 cent to 51 cent threshold, which would coexist with the full-on retracement of this previous bullish move. That would signal to me some phenomenal buying opportunities on XRP. As much as people don't want to see price back down there again, I would reaccumulate and stack some huge XRP positions for a possible formal recovery long term, right? This to me looks so much more logical for them to do something like this than for them to do it from here. So we'll see how that plays out. You guys have both bullish and bearish targets in the most immediate vicinity to be mindful of. Taking a look at Solana real fast on the higher time frame, as I'm going to start tracking Solana's price action now with the dark pools as well. Right now, we have seen a rejection of the 85, excuse me, 0.11 dark pool. We failed to sustainably hold above the 80.14, where we had buyers try to make an attempt to defend the dark pool. Sellers became aggressive, broke the dark pool. Then we had a passive seller defend against these buyers at the dark pool. And from there, we started to create bearish order flow all the way down until we broke the 74.38 and came into the 69.72 dark pool. So for now, as of time of recording, it looks like we're still operating in this bullish range. So as long as we are trading in this A to B move, I am optimistic that Solana can continue its upside trajectory. So slight pullback down into the 63.60 makes sense to come and respect the base at the low of this previous bullish move. So even if we were to pull back slightly down into the 63.60, that would still present a bullish opportunity on Solana to continue this overall momentum. Creating a new bullish leg above the $85 threshold would be a nice move to possibly start to come and take out all of this previous bearish price action, targeting the highs at the dark pool around the 94.16. If we don't see a drop down into 63.60 and we do see buyers continue to defend 69.70 and push up into 74.38, a sustainable break and hold above the 74.38 would also coexist with the moving average crossover. We'd probably see an attempt to turn the 50 EMA into support. If we can retest the 74.38, then we could also see another meaningful recovery and attempt to take out the high at around $80 to $85. That would be the bullish scenario this week on Solana in an optimistic environment. A failure to hold this base would be the first signal that sellers are still clearly in control. Just like on the total cryptocurrency market cap, we can clearly see that on the higher time frame, on the daily and the weekly, we are still operating in this last bearish leg from A down to B. Even though we've seen a small bullish recovery, we have not broken above the previous bearish lower high that broke previous support, which shows us that until we start to make a formal attempt at taking out these highs here and these highs here, sellers still have the opportunity to defend at these levels and push price back to the downside. So with that in mind, if at any point in time we see sellers gain the upper hand, sentiment skewed to the downside, risk-off narrative continue to flourish, and a break below this recent base in between $69 and $63, the next bearish target to the downside is going to be $54.71. That right now is the lowest level dark pool on Solana. So I will start to significantly accumulate more Solana, more so than I already am, if we do see those levels come into fruition. Underneath of $69, the most immediate bearish threshold is 63. Underneath of 63, we have the 54.71. All right. Now you guys both have bullish and bearish targets on Solana to be mindful of.